European stocks taking a hit today amid the president's announcement, while U.S. stock futures fluctuate and point to a lower open as investors digest tariffs and how they could impact the U.S. and global economy. Fitch Ratings today saying the impact of U.S. tariff hikes are beginning to appear in macro data. Joining us now, we've got Seema Shah, Principal Asset Management Chief Global Strategist. Seema, good to have you here with us this morning. Just help us make sense of the policy negotiations that have been put forward thus far and what type of recession risk profile you're placing on that.
Good morning. Well, I think in terms of the policies that we're seeing come through, the biggest surprises, I guess, has been really in the sequencing to which it's come, with the initial expectation being that there'll be some kind of shoring up of the US economy before you get some of the hits such as tariffs. Of course, that hasn't happened. We start off with tariffs, and actually the impact is set to be more severe than I think anyone was anticipating at the beginning of the year. So from our perspective, the odds of a recession have increased quite clearly. We have concerns about what is going to happen to consumer spending, how the labor market is going to respond to the Doge-inspired job cuts. But overall, we still think that in the second half of the year, we're assuming that there's going to be some good news coming in, either in terms of the extension of tax cuts, deregulation, and hopefully Federal Reserve rate cuts. Now, a lot of that is steeped in uncertainty. Even today, specifically with the announcement of auto tariffs, it really does raise the risk that inflation moves a little bit higher than what people are anticipating, which would make it certainly a lot more challenging for the Fed to move forward with additional rate cuts.
And Seema, it makes me wonder, since you mentioned the Fed and obviously the policy uncertainty, how much is the market relying on either a Fed put or a Trump put, and perhaps both of which are not here anymore?
I think there is some reliance. You know, when we're thinking about at least what the market is anticipating for the Fed, they're only pricing in one or two cuts this year. So it's not very, very significant. But I think it's the idea that, look, if the Fed was in a position where it couldn't cut interest rates because of inflation concerns, and at the same time that inflation is really eating into consumer spending, then I think the market would certainly respond quite negatively. So we can see this feeding in through today. The market is really responding in a negative reaction because of the concerns around inflation and then what position that puts the US and the US Federal Reserve in.
Now, when you look out to the second half of the year and then pair that with the strategy for equities investors out there, does that seem, especially as we're kind of remembering that equities investors typically look months out, try to look through perhaps the largest shocks, does that seem then like we may have already seen the bottom, at least for some of the slippage that earlier or over the last month has taken place and transpired?
I mean, I think we may well be. I think there's still some uncertainty to come. And of course, we know that markets really don't like that aspect of this kind of policy environment. It depends on when we're going to get that clearing event. Is it next week on the 2nd of April, or are we looking further out into Q2? But I think that equities already have had, of course, a downshift. There are concerns around what is going to happen to earnings, not just, of course, in the tech sector, but this assumption at the beginning of the year that there would be a broadening out of earnings growth to other sectors is now being tested with a number of announcements that are coming through. So from our perspective, it could be that in at some point in early Q2, when you get some level of certainty around exactly what the Trump administration is going to be doing, not just with tariffs, but also with Doge, with deregulation, with tax cuts, that is when you could see investors starting to feel a bit more confident about how to invest in this environment.
Given that uncertainty is kind of the word of the year right now, Seema, I wonder how you're thinking about diversification in this environment. How are you advising clients on diversifying their portfolios to be able to withstand some of the pain that may come as we await that second half of the year?
Right. And as you said, you know, uncertainty is the number one word. Number two is diversification. I think this year, coming into the year, already investors were starting to think about global diversification increasingly because of the valuation disparity that was on display across the world. And now what we've seen in the last couple of months is that actually countries have looked to reshore. They themselves have shored up their economy in order to protect themselves against some of the cross currents coming from the US. So that has made other countries outside of the US more interesting, fundamental improvement, which I think has added to the case for global diversification. And then in addition to that, from an asset allocation mix, you know, when you have got downside economic risks, you need to have exposure to fixed income, high quality fixed income, investment grade, preferred securities. Those are the areas that you need to be thinking about, as well as, of course, look within equities, global exposure, high quality sectors with high quality, strong balance sheet, strong cash flow, and then also within fixed income too.
I guess further to that end, Seema, just to elaborate a little bit more, within uncertainty, where is the highest conviction trade or asset allocation right now?
It's a good question. I don't know if there is anywhere really that has very, very strong conviction. We are seeing that investors are actually taking more interest in some parts of the world that they feel are less vulnerable to tariffs, that may be almost considered a bit boring in a way because they're not doing much from a policy side or anything. So actually, flows into the UK have been surprisingly strong for that specific reason. But I think overall, it's really about fixed income, investment grade, high quality, which provides that downside risk. If you do have, if we are hoping to see Fed cuts later this year, some reassurance that that's coming, that's going to be adding to that case for fixed income.